At its most recent meeting, the Bank of Canada maintained rates and spoke about the downside risks to inflation. The central bank said it expects inflation to return to its 2% target in about 2 years. Now, I have Derek Burleton, Deputy Chief Economist at TD Bank in Toronto, on the line. So, Derek, do you think we will see a rate cut this year? And do you agree with its inflation outlook?
I don't think we will see a rate cut this year. In fact, I don't think the bank will move to an explicit easing bias, which would have been the next step towards a rate cut. When you look at their forecast, they've actually upgraded Canadian economic growth forecast, in part based on the recent performance of the economy. So that actually is a tick in favor of keeping rates stable. And their inflation view hasn't really changed. They had that slow climb back to 2% inflation in their last forecast, and they pretty much just maintained it. So I viewed today's statement as being very much status quo, and provided the economy proceeds as forecast, I think it just means rates remaining stable at 1%, at least until the tail end of 2015, but real no dramatic changes to their stance on monetary policy in the short term.
The Bank of Canada sees global growth strengthening over the next 2 years, rising from 2.9% last year to 3.4% this year and 3.7% in 2015. Now, are you expecting something similar, Derek?
We are. The bank's view is very much in line with most private sector forecasters in Canada. It's a very mixed picture for the economy. You've got a consumer that's fairly tapped, not a lot of upside potential for growth there, but kind of a modest increase on the horizon. They've got that. The big reason for the pickup is tied to the view on the U.S. economy, an improved U.S. economic picture. That's something they did upgrade in terms of their medium-term outlook and the benefits that will deliver to Canada, along with a lower value of the Canadian dollar. So really the pickup seems reasonable in view of a stronger U.S. economy and better exports. So comfortable with the bank's medium-term view on the economy.
The Loonie fell to a 4-year low on the back of this news. Now, Derek, can you tell us more about market reaction and what is your forecast for the Canadian dollar?
The market has taken a more dovish take on the statement. My view was that it was very much a status quo statement, but I did see the Loonie falling even further, bond yields dropping following it. The only thing I can chalk that up to is the fact that in the statement, the Bank of Canada moved the downside risk, which is low inflation, to the top end of the statement and moved some of the good news further down. And I saw that as semantics. I think the markets interpreted that as a step towards the dovish camp and moving to an explicit easing bias. So a little bit of a different interpretation there. But all I can say is that the Canadian dollar is just a continuation of bearishness, and until we hit a new technical level, which is close to 90 cents, we might just continue to see the declines regardless of what the Bank of Canada had said.
Derek, thank you very much. As always, it was a real pleasure. Well, viewers, do stay tuned as we have plenty more coming your way. Goodbye for now.